Should you work for money or for passion? And how can you make money work for you? Should you invest your hard-earned money in the share market or should you invest it in fixed deposits with banks? Is share market really risky and are FDs really safe? Is it possible to get really rich, creating wealth to the tune of around 100 crores or so without taking any significant risk and without having to acquire any detailed technical knowledge? And if it is really that simple, why isn't everybody making all that money? And what if somebody is so unlucky that he always has extremely wrong timing of entering into the stock market, buying the shares just before a huge crash? What will happen to his investment? We'll find out all this and much more in this video. So if getting rich is an important goal of your life, and especially if you are in your 20s or 30s, or if you are a well-wisher of someone who is in that age group, then not watching this video till end might be one of the biggest mistakes of your life. So let's get started. Two main reasons why people do not invest in stock market. One, because they think it is very risky. And two, because they think they do not have enough knowledge about it. What if I tell you, just watch this video till end, and it would be nearly impossible for you to lose money in the stock market. And two, you would hardly need any special knowledge for this. But before that, a quick fact. Do you know if you had invested rupees 10,000 in shares of a company called Wipro around 40 years back, how much it would have become by today? Approximately 700 crores. But of course, that requires extraordinary research, knowledge, risk-taking, and the ability to analyze and foresee the potential of any company or the industry which others are not able to see. And that is something what active investors do. But we are not going to discuss that today. Because this video is for those passive investors who do not have time to do all that research or acquire that technical knowledge and also do not want to take any significant risk. It sounds like I'm going to suggest you to invest in some bank FDs. Of course not. And I'll tell you why. See, when you invest in a bank FD, say at 7% interest rate, although nowadays you're hardly getting even 5 to 6%, but let's say some generous bank is giving you 7% on FD. It means the bank is borrowing money from you at 7%. So obviously they will lend that money to somebody at a higher rate, say around 9, 10, 11%. And the companies will borrow money at that rate only if they can generate some 14, 15, 16% return. Otherwise, why would one take all that risk? Now here let me introduce a simple rule called rule of 70, through which you can find out in how many years your money gets doubled. So if you are getting 7% rate of return on your investment, your money will get doubled in 70 by 7. 70 divided by 7, that is 10 years. Whereas if your investment is generating say 14% return, your money gets doubled in 70 divided by 14, that is in 5 years. So if you had invested 100 rupees in an FD giving 7% return, it would have become 1600 in a span of 40 years. Whereas if you had invested that 100 rupees in some investment giving 14% return, it would have become 25,600 in a span of 40 years. But where will you get that 14% return? Let's check out Sensex, which is nothing but an index or a dynamic basket of top 30 companies of India. Sensex started in 1979 with a base value of 100. And assuming 14% return, it should reach 51,200 by 2024. But we are still in 2022 and we've already touched 60,000 mark. meaning Sensex has been giving an average return or CAGR, compounded annual growth rate, of more than 14%. Actually, it has given 16% return. So when you are investing in Sensex, it is like you are taking partnership in the top 30 companies of the country. Or if you are investing in Nifty, you are investing in top 50 companies of the country. And that is called passive investing, when you don't have to do the research as to which company to invest in. By investing in the underlying index like Sensex or Nifty, you automatically remain invested in the top 30 or top 50 companies of the country. Now somebody may ask, what if any of these big companies also fail? Yes, even big companies may also fail. But one or two companies failing will not have any significant impact on your return, because you have diversified your risk by investing in a basket of companies rather than risking all your money with just one or two companies. Now the next question could be, if all the top 30 companies fail, then what? That is never going to happen. But even if we assume for a minute that all the top 30 companies of India fail at the same time, then in that case, your entire economy will collapse. And these companies will not be able to repay the money they have taken from banks. And therefore, banks in turn will not be able to repay the money they have taken from public in the form of FDs. So by that logic, even your fixed deposit is also not safe. Now one may argue, of course, we know that these companies do not fail, but their share prices go up and down. We have seen Sensex also going down so many times. Of course we have. In fact, for your kind information, Sensex has been witnessing around 10 to 20% intra-year decline almost every year. And to be more precise, only 3 out of the last 42 calendar years, it had seen intra-year decline of less than 10%. Meaning 39 out of the 42 years have witnessed a more than 10% decline. But despite an intra-year decline of more than 10% nearly every year, 75% of the time, that is 3 out of 4 years, it has ended up with positive returns. But these are all temporary fluctuations, which you should not be concerned about at all. Because we are talking about long-term investment of at least 15, 20, 30 years time horizon. Of course, the longer the time horizon, the lesser the risk. Now if somebody says that I'm so unlucky that whenever I invest in stock market, it falls immediately after that, what will happen to his investment? Let's find out. Mr. M.L. Srinath of Funds India, through his research involving backtesting of around 20 years data, has tried to explain this by taking an example of 3 hypothetical investors. And he has named them Mr. Unlucky, Mr. Humble and Miss Lucky, who had been investing in Nifty 50 based index funds, wherein Mr. Unlucky would always invest just before the market is about to fall by 20% or more, whereas Miss Lucky would enter at the bottom of these market falls. And Mr. Humble invests through monthly SIP, systematic investment plan route, without trying to time the market. Any guess how much would be the return of Mr. Unlucky? A decent 11.8%. Far better than any FD or debt returns. Also, Mr. Humble's returns, who had opted for SIP route, stood at 14.7%, which were pretty close to 16% return generated by Miss Lucky, the perfect market timer. So the obvious suggestion is go the SIP way. Because in SIP, when market is high, you would be happy because of good returns. And when the markets are down, you would still be happy because you would be buying cheap at better valuations. In fact, you should never try to time the market or wait for corrections. Because even the greatest investors of the world have not been able to get the timings always right. And as the legendary investor Peter Lynch says, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. But I'm sure you might be wondering why the returns were reasonably good even for Mr. Unlucky, who was always investing at the wrong time. The answer is really simple. Time and the magic of compounding. Though the unlucky investor invested only at the wrong time, he didn't take his money out after that and withstood all the future declines without panicking out. This simple but difficult act of patience gave the portfolio a long enough time to let the compounding work its magic. Albert Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." Let's understand with the help of an example. Let's say you are planning to buy a car in the range of 30 to 35 lakhs in a month's time. And the car dealer gives you two options for payment. Either you pay rupees 1 lakh per day for next 30 days, that means 30 lakhs in total, and on 30th day, you take the delivery of the car. Alternatively, you pay 1 rupee on the first day, and next day, double of that, that is 2 rupees, third day, double of that, that is 4 rupees, fourth day, 8 rupees, fifth day, 16 rupees, sixth day, 32 rupees, and so on and so forth for 30 days. And on 30th day, take the delivery of the car. Which option would you choose? Prima facie, the second option might look more attractive. But do you know how much would you have paid if you had opted for the second option? More than 107 crores in total. And that is the magic of compounding. That is the power of compounding. Now let's take a realistic and practical example. If somebody in the beginning of his career starts investing through an SIP route of rupees 20,000 per month for next 40 years in an investment avenue generating 15% CAGR or annual return, and through this he would have invested less than rupees 1 crore during the entire period of 40 years. And guess what? It would give him a corpus of rupees 62 crores at maturity. Interestingly, this is when he is keeping the SIP amount same as rupees 20,000 per month throughout the entire period of 40 years. However, if he decides to step up his SIP amount by 2,000 per month every year, in line with the normal increase in his annual income over the period of time, then the sum would become rupees 101 crores at the end of the tenure. Of course, this 101 crores after 40 years will not have as much value as today because of inflation. So even if we adjust this amount by an inflation rate of say 6%, then this would be equivalent to around 10 crores of today. 101 crores 40 years from now is as good as 10 crores of today. That's not bad either. And here comes the most exciting part. If you just let this investment continue for 5 more years, you would get 214 crores instead of 101 crores. Meaning, while it took 40 years to make your first 100 crores, the next 100 crores took less than 5 years. And that is the real magic, real power of compounding. And that is the key lesson I want you to understand and appreciate. If you feel that these passively managed index funds may not be able to give you 15% return in future, you can also check out the actively managed mutual funds, which can outperform the index funds even after we account for their higher fund management charges. Worse come worse, if you're not able to get 15% and if you settle for 14% or even 13% return, you can still achieve your target by either increasing the SIP amount or the tenure. But that's not important. The important thing to note is the power of compounding and taking full advantage of that. Now you might be wondering, if this is so simple to be rich, then why isn't everybody following this strategy? So the answer is simple. Either many people are not aware about it, like I wasn't aware when I was 20 years old, to be frank. And I wish somebody had told me all this when I was in my 20s. Or even if people are aware about this, they might be lacking in one or more of the following 5 important traits which are must for this magic to work. First thing first, you must have faith. Faith in equities over the long term, faith in Indian economy, and faith in India's growth story. Second, you should have the ability to suffer in the short term, making those small sacrifices like not buying that iPhone or that new car or new house, etc., in order to continue your SIP. Third, because of the short-term volatility or ups and downs in the market, you will go through a lot of emotions like greed or panic or fear, or simply the temptation to splurge or spend that money for showing off. It's not easy, but you will have to control and manage your emotions. And that brings us to one of the most important traits, that is discipline. Irrespective of what happens in the market, you need to maintain the discipline of investing month after month, year after year, without fail. And last but not the least is patience. The biggest challenge for long-term investing for 15, 20, 30, 40 years horizon is this, patience. How many people in their 20s would think of retirement planning? Very few. But those who do would emerge as the winners in this game. So if this video can help some people achieve their financial goals or financial freedom, I think my job is done. However, if your objective is to achieve happiness, then let me tell you, beyond a point, money may not necessarily make you happy. So if you want to be happy in life, then I would suggest you to try and see if you can identify your passion and turn that into a career. Or other ways of being happy could be just be kind, spread love, appreciate what you have, appreciate people around you, and genuinely help someone without expecting anything in return. And of course, stay healthy and keep smiling. Thank you. Jai Hind.